Imagine waking up on the first business day of every single month to a deposit of $900 to $1,200 in your brokerage account, from an ETF that owns the exact same real estate stocks your parents have been buying for 20 years in the Vanguard REIT fund. Same companies, same sector, same boring chart. Except yours is paying triple the income, 11.01% annualized right now, while theirs is still stuck at 3.9%. And the wildest part? With dividends reinvested, this fund is quietly outperforming every major non-covered call REIT ETF on the planet since the day it launched. How is that even legal? Today, Troy Cates, co-founder and managing partner of Neos Investments, is sitting here with zero script, zero slides, and zero reason to hold anything back. We are going line by line through IRI, the Neos Real Estate High Income ETF, to answer every single question you've been screaming in the comments for the last 6 months. This is part A of the longest, most transparent breakdown I have ever done on a single fund. Grab something strong, you're going to want to hear every word. Troy leans back and explains that Neos never set out to be another covered call shop. They see themselves as a solutions provider that keeps slicing up the classic asset allocation pie into higher income tax-efficient pieces. They started with the core equity bucket, SPYI on the S&P 500, then core fixed income, BNDI, then ultra-short cash alternative, CSHI. Then they moved into growth, QQQI on the NASDAQ 100. Then small caps, IWMI on the Russell 2000, then alternatives like Bitcoin and gold, and the entire time they kept getting the same question from financial advisors and direct investors: can you guys please do your thing on real estate? I already own REITs for diversification and income, but 3.9% isn't cutting it anymore, so Neos said, challenge accepted. They went to work and launched IRI, the Neos Real Estate High Income ETF, designed from the ground up to take the exact same broad REIT exposure everyone already knows and loves and supercharge the income using their proprietary covered call overlay. As of October 31st, 2025, the trailing 12-month distribution rate on IRI is 11.01% annualized. The average dividend yield across the entire U.S. equity REIT universe right now is hovering right around 3.9%. That means, roughly 7% of the extra income is coming from somewhere that isn't the underlying REITs themselves. But it's not leverage. It's not mortgage REITs blowing up. It's not some secret sauce stock picking. It is 100% options premium harvested by the Neos trading desk. Here's exactly what lives inside the fund. First, the underlying basket. IRI tracks the Dow Jones U.S. Real Estate Capped Index. That's the exact same index that the iShares U.S. Real Estate ETF, ticker IYR, has been tracking for decades. It holds between 60 and 65 individual REITs and real estate operating companies, everything from cell tower giants like American Tower to healthcare REITs like Welltower, industrial monsters like Prologis, retail like Simon Property Group, and of course the monthly dividend legend Realty Income. Those underlying holdings naturally pay dividends that currently annualize to about 3.9%, and every penny of those dividends gets passed straight through to you, the IRI shareholder. Second, the options overlay. Because there are no listed index options on the real estate sector, the CBOE has never launched a REIT index option chain. Neos uses Flex options on the IYR ETF itself. Flex stands for Flexible Exchange Options. They're fully customizable contracts that let Neos pick the exact strike, the exact expiration, and most importantly, European-style cash settlement so the underlying shares can never, ever be called away. They roll these options roughly every 7 weeks, always landing on the third Friday expiration of the following month. And they do it at the very end of each calendar month, so the distribution schedule stays perfectly monthly. Right now, the overlay is covering approximately 75% of the portfolio's notional value and leaving 25% completely uncovered. That ratio isn't static. It moves every single month based on where volatility is, but we'll come back to that in a minute. The premium collected from selling those calls is what bridges the gap from 3.9% natural REIT yield to 11.01% total distribution. A lot of covered call ETFs hard-code 100% coverage and call it a day. Some do 50% or 60% and say they're growth-oriented. NEOS does something completely different. They let the model decide every single month how much coverage is optimal to hit their 10 to 12% distribution target while still leaving meaningful upside participation. Troy walks through it like this. Every month when they roll, the model looks at current implied and realized volatility in the real estate sector and asks two questions. Question 1. How far out of the money do we need to write the calls to generate enough premium? Question 2. How much of the portfolio do we actually need to cover to hit the target? Some months, volatility is sky high, and they can write calls 4 or 5% out of the money and still generate huge premium with only 50 or 60% coverage. Other months, volatility collapses, and they have to creep the strikes closer to at the money and increase coverage to 80 or even 85% to keep the distribution in the band. Right now, they're sitting at 75% coverage with calls roughly 2 to 4% out of the money, which is exactly why the yield is printing 11.01%. That dynamic coverage is the secret sauce that lets IRI stay inside the 10 to 12% band with shocking consistency while still giving investors a real shot at upside if REITs ever decide to rip again. Here's the part that makes people's heads explode. Conventional wisdom says covered call funds should lag their underlying index in bull markets because you're selling away the upside. Yet since IRI launched, with dividends reinvested, it has outperformed VNQ, SCHH, and even IYR itself on a total return basis. How? Because the REIT sector has been almost completely flat for 2 years straight. When the underlying goes sideways or slightly down, a modestly out-of-the-money covered call strategy is the single best performing strategy in existence. You keep 100% of the premium every single month, the underlying dividends keep flowing, and the total return ends up higher than just owning the boring REITs that pay 3.9%. Troy puts it bluntly, in flat to down markets, covered calls almost always outperform the underlying on a total return basis. That's exactly what we've seen play out in real time with IRI. Every October, NEOS is required by SEC rule to post a 19-1 notice estimating the character of the upcoming distribution. The October 2025 notice showed roughly 84% estimated return of capital. People see return of capital and immediately think they're giving me my own money back. This is a scam. Let's kill that myth right now with crayons. Return of capital is an IRS accounting classification, not a description of what's actually happening in the real world. Here's the play by play. First, you own shares of IRI. Second, the underlying REITs pay their normal dividends. Those come out as qualified dividend income. Third, NEOS sells calls and collects premium. That's option income. Fourth, if the calls expire worthless, which happens most months, the premium is a realized gain to the fund. Fifth, because the underlying rate basket might have unrealized losses or other accounting offsets, the IRS allows the fund to classify a portion of the distribution as return of capital instead of ordinary income. Sixth, return of capital does not mean your principal. It simply means we're lowering your cost basis and deferring the tax until later. Here's a real-world example from 2024 on SPYI. The fund was up 24% total return, paid 12% cash, and 94% of that 12% was classified as return of capital. Translation: investors paid zero tax on their cash flow that year and deferred everything to long-term capital gains rates, which could be anywhere from 0 to 20% whenever they eventually sell. Troy says it best. We're not trying to return principal. We're using an IRS rule to make the income as tax efficient as humanly possible. Troy is crystal clear about the risks. Interest rate risk is real. REITs hate rapidly rising rates, and we lived through that in 2022. There's also sector risk. If commercial real estate has another leg down, 65 names won't save you. Opportunity risk is another factor. If REITs rip 20% in a year, you'll only capture maybe 5 to 7% of that because of the calls, and there's no 12, 56, 60, 40 tax treatment because they're using flex options on an ETF, not true index options. He finishes with, "We're not here to tell anyone they have to own real estate exposure. We're just saying if you already do, or you want to, here's the highest income, most tax-efficient way. We know how to do it." Chasing the single highest-yielding mortgage rate, and then watching it cut the dividend by 70%, thinking, "I'll just buy a physical rental property," and forgetting that ETFs have daily liquidity while houses can take 6 months to sell, and looking only at the distribution rate and ignoring total return. He's seen people buy funds yielding 18% that were down 40% on price. That's not income, that's slow death. So, the top 10 in IRI right now are, in order, Welltower Prologis, American Tower, Equinix, Simon Property Group, Realty Income, The Monthly Dividend Legend, Digital Realty, CBRE Group, Public Storage, and Crown Castle. These are exactly the same names and weights you'd see in IYR or VNQ, since they all track the identical index. Troy laughs when I ask if he has a favorite. I genuinely don't. Our expertise is the option overlay, not picking individual REITs. We let Dow Jones and S&P do that part perfectly. Yes, he does. Troy and his partner Garrett Paolella actually own every single NEOS product in their personal accounts, just with different weightings. Troy confirms that IRI is in both of their portfolios because, they believe there's a real place for high-income real estate exposure in a diversified sleeve. The expense ratio is 68 basis points, which is exactly in line with SPYI and QQQI, and that's because it's active daily, weekly, and monthly option management. Holdings are posted every single night on neosfunds.com, not just monthly like most funds. Welcome back, legends. If you made it through Part A, you already know that IRI is quietly handing investors 11% plus in monthly cash flow on a basket of REITs that, by themselves, only pay 3.9%. The options come from flex contracts on IYR, the coverage floats around 75%, and the distributions are staying shockingly consistent even while the REIT sector has been basically flat for 2 years. But now we're going full nerd. No slides, no tables, no bullet point cop-outs here. Just me walking you through every single layer of this machine, the same way Troy walked me through it when the cameras were off. We're talking real October to November 2025 roll math. What a $50 million creation actually looks like in real time. How the CSHI put spread engine prints money every single week. Why IWMI might be the biggest sleeper in the entire NEOS lineup once the Fed is done cutting, and exactly why the tax treatment on these funds is so stupidly good that, honestly, most brokers still don't know how to code the 1099s properly. Buckle up. This is the longest, most detailed Part B I've ever written. Alright, here's everything you need to know in one breath. Imagine owning the exact same 60 to 65 blue-chip REITs that your parents probably have in their Vanguard fund, Prologis warehouses, Welltower nursing homes, American Tower cell towers, Simon malls, Realty Income, Monthly Dividend Legend, the whole gang. Those REITs, by themselves, pay you 3.9% in dividends and have been basically flat for 2 years. Now imagine taking that identical basket, handing it to a team of 20-year veteran options traders, and letting them sell monthly flex calls, custom strikes, cash settled, no early assignment, against roughly 75% of the position, leaving 25% completely naked, so you still get upside when REITs finally move. The premium from those calls, plus the 3.9% natural REIT dividends, gets paid out to you every single month, landing at 11.01% annualized right now, with a stated target of 10 to 12%. The coverage and strike distance change every single month based on volatility, so the payout stays freakishly consistent, while still giving you a real shot at total return outperformance, which is exactly what's happened since launch. IRI, with dividends reinvested, has quietly beaten VNQ, SCHH, and IYR itself in a sideways market, because you keep 100% of the option premium when nothing happens. You get daily liquidity, daily holdings transparency, no K1 nonsense, and because of the way the option gains interact with unrealized losses in the underlying basket, most of the distribution shows up as return of capital on your 1099, meaning little to no tax today and everything deferred at long-term capital gains rates later. It's not 12, 56, 60, 40 treatment. They use flex options on IYR, not index options, but the ROC outcome is often even better. Risks are simple. Rising rates kill REITs. A 20% REIT rally caps most of your upside at roughly 5 to 7%. And if commercial real estate implodes, diversification won't save you. But if you already wanted real estate exposure or you're looking for the single highest paying, most tax-efficient monthly paying diversifier on the planet right now, IRI is it. Same stocks your grandpa owns. Triple the income. Same liquidity as SPY. And the two founders own it in their personal accounts alongside every other NEOS fund they've ever launched. That's IRI in one flowing breath.